Hi, it's Mel Dennis here from Domain & Co. I'm sitting with Katie Byron from Propeller Advisory. Katie specialises in business and personal accounting issues. I guess to start with, Katie, maybe let's have a chat about the changes and things that people need to be wary of putting in their tax returns this year.
Yeah, perfect. So as you might have seen in the media a lot lately, the ATO is cracking down on individual tax returns and the deductions that individuals have been claiming. Historically, we have been able to claim certain things without receipts and evidence of actually incurring those expenses, and the ATO has come back and said no, that's actually not correct.
And they're clamping down a lot, doing a lot more auditing now.
They are, yeah. So basically, if your expenses are dissimilar to what they were last year, or dissimilar to other individuals within your industry, within your job title, then they will come and they will question you and say, well, how come you're so far out of the rest of the
and
quota?
So looking at if your job hasn't changed, really your expenses should remain the same.
That's
Maybe
right.
if you've had a job change or a total industry change, then you might see some significant differences.
Yeah, that's right, exactly. And there might be things where you might decide that you want to do a course, but that course has to relate to your job. And so they might be reasons why your expenses would increase, but really other than that, they shouldn't.
Okay. Fantastic. And some of the changes that people should be wary of?
Yeah, so the changes mainly, or I guess the items that the ATO is cracking down on are laundry, work-related vehicle expense claims, mobile phone, internet, home office. Those ones tend to provide individuals with quite a large tax deduction. And sometimes the ATO is finding that they're not legitimate, so they're really wanting to see supporting evidence of those.
And working from home and claiming your home office, that could have repercussions down the track from a capital gains perspective when you sell?
Absolutely, yeah. So if you own your house, then you really need to be talking to an accountant about the best way to claim a home office if you're going to do that, to avoid any CGT implications.
I think it can be one that people fall into the trap thinking it's their own home and there's going to be no problems with it, but because they've made deductions all the way through from having a home office.
Absolutely, yeah, they'll get nasty effects from that.
Yeah, absolutely. And rental properties, there's been a few changes there as well, with depreciation and...
So there's been a couple of changes actually in the prior financial year in regards to rental properties, and the ATO saw that people were still claiming these deductions in the last financial year, even though the changes were made. So the things to really be aware of there is travelling. You can't claim any travel to your rental property. So if you're in Melbourne and you have a rental property in Queensland, no, you can't claim your flights.
And that's the other reason those Queensland properties were bought from Melbourne, weren't they? Get a bit of a holiday in there at the same time.
Yes. And there's been a few changes to depreciation as well, whereas if you purchased a property that had been lived in previously, you can no longer claim the deductions on plant and equipment that exists within that property.
So some really great tips there, Katie. Thanks so much. Katie's details will be in the comments below, so if you do want any advice around your tax and claimings this year, I'm sure Katie would be very happy to hear from you.
Perfect. Thanks so much, Mel.
Thank you for watching another one of my professional property series interviews. I'd love to see your comments, and please like and subscribe to my social channels on Facebook and YouTube. I welcome any suggestions for new topics too.